that our stand costs $2.50. We're going to do the same thing on the scale for our donut shop as well. Except we're going to forecast it out. And a lot of it is, do we know how much it costs to make a donut? For those of you who've been in my managerial accounting class, we spend an entire semester talking about how much does it cost to make a donut. Been doing it for 6 years now, and I have an idea of what donut costs, and I could still bring in my partner and we'd argue about how much it costs to make a donut. So with that going on, we're going to do a similar exercise, but we're forecasting out. Does anybody in here know how many donuts we're going to sell tomorrow? No, we don't. So we've done our research, and a lot of what we've spent the last several classes doing is figuring out who the customers are, what are sustainable advantages, starting to make an assumption on what those sales numbers are, and we've done our research. We know our ingredients cost more than the bad ingredients. We know all these different things. So now we've at least got to make assumptions on how we're going to run our business, right? So from there, we start to create our financial model. And as you'll see that's attached to the module, there are several examples. This isn't the only way to do a financial model. It's just one that we're going to do for today for our business. So right off the bat, we're going to separate our products. And in our business, we are going to sell donuts. We are going to sell pastries. We're going to have a couple cinnamon rolls, maybe a couple muffin tops. And then from there, we're also going to be selling coffee, okay? So from there, we want to figure out how many cups of coffee we're going to sell per period. As you can see right here, I've gone for a total of 12 periods. That could be 12 months, 12 years. And usually what you do is you take how many periods you're going to do. 12, let's say we do 12 months, then you can start saying that's 1 year, and then you start doing forecasts for the next 2 or 3 or 4 years on how you want to grow your company. I'm using 12 just as a starting point. Let's figure out what the first year is going to look like. We will redo our forecast for the following years after, and really that's where a lot of companies make economic rents. That's where they truly make their money going forward, and they make decisions for expansion. The bigger issue is while we go out further with that, it's still just a guessing game. So let's make modest numbers. Let's use some modest estimates going forward. So first off, of our products, we're going to have our sales. We're selling our donuts, our pastries, our coffee. This is our revenue, okay? We're going to have the cost of each of those. No different than our cost of our lemonade. We have the cost of goods sold for our donuts, our pastries, and our coffee. And we have our cost of goods sold for everything we did. So if this was lemonade, it's no different than the chart there that we did in the previous module. From there, your sales less your cost of goods sold is your gross profit, but you're not completely done at that point. What else do we need to do to start our shop? What do we need to start our shop up? Huh? We needed property, we need cooking equipment, we need all that. And do you buy that every single month? Do you buy a stove every month? No, but you need it to start up. So what we also do is we have our startup costs. We have our kitchen equipment. We have a point of service system, a cash register, and we have additional costs for furniture. And remember, we want this to feel like grandma's house. This is going to be Nana's Donuts, right? So we're going to spend some money there as well. Then we have our general selling and administrative expenses, right? Rent, advertising, utilities, what else? Payroll. Payroll, we want to pay people, right? Or not. Yeah. Right. So from all there, we have our total selling, general, and administrative costs. And then our sales, which we subtracted our gross profits, came up with our gross margin. Then our gross margin less our startup costs and our SG&A costs give us our net income, or in this case, net cash inflow or outflow, right? Couple of notes. For this example, we're a donut shop, we're a cash business, right? When you buy a donut, when do you pay for it? Right now, exactly, right? When you buy a car, when do you buy it? Over the course, so, and no different with businesses. There is some further analysis. For this exercise, everything's a cash business, but you may do forecasts, right, for accounts payable, accounts receivable. And what you actually may do is do the exact same exercise we're doing here based on an accrual basis. It's covered in the textbook. But then go back and say, for everything we sell today, we will not collect it for 45 days. So sometimes you have layers and layers of these that reflect those types of variables. For today's exercise, we are going to luckily be in the cash business. If you do find anywhere where you can buy donut on credit, I advise against it, okay? So as we get started, what we want to start doing is we want to start forecasting what we think our sales are. So for the first month, we're going to say we think we can sell 900 donuts in the first month, 400 pastries, 975 cups of coffee, right? Now, we don't know this for sure, right? But we've talked around, we've talked to the owners of similar businesses, people who are competitors, people who are outside of our competitors. No different flipping chicken that we talked about earlier. Not even a competitor, but our question was, how many people come in here every day? What do sales look like, dollar-wise, and number of customers? This right here, number of products sold. It's in units only, okay? But it's no different as we start to chart it out throughout all 12 months. We start coming up with a sales forecast on units, right? Now, luckily, we know what we're going to sell our donuts for. We've done our research, and we have figured out that we can sell our donuts for $3.25 a piece. We can sell our pastries for $4 a piece, and we can sell our coffee for $2.75 a piece, right? So going back to our lemonade stand, the math is no different, right? This is a hell of a lot uglier than what we just did, right? That other one had little pictures and colors and everything all over the place. This is this exact same concept. It's just spreading it out over a longer period of time. And really, if you could take this data and chart it no different than we did in the last exercise. But from there, all we're doing is we're multiplying our 900 donuts sold in the first month times $4 to give us $2,925. And all the examples I gave you are in Excel. I would highly expect all of you to perform this in an Excel spreadsheet rather than by hand. And you forecast your sales dollars out based on your unit. But that really is no different than when you get to your cost of goods sold, because based on our analysis, we think the cost of our donut is $1.55 a piece, a cost of our pastry is $1.20 a piece, and the cost of our coffee is 75 cents a piece, cup and all, packaging and all, right? And based on the batches we've done, we think that's exactly what that will cost. Again, going back to accounting and managerial accounting, how do we figure out how much a cup of coffee costs? How much do we think a donut costs? We could dive in there for days. We could literally say one donut requires a half a tablespoon of flour, 1 tablespoon of sugar, and measure what those costs are and say it's $1.36. Or we could make 500 donuts and say 500 donuts cost us, $1,000, therefore a donut costs us $2. There's 10 different ways you can, actually 10,000 different ways you can come up with how much the donut costs. But at this point, you do it to the level of the research that will benefit what you're trying to accomplish and the information you're looking for. So as we forecast that out, we come up and we have our cost of goods sold, which also our formula for our gross margin is just our total sales minus our cost of goods sold. Again, going back, we need the shop. We need if we were buying land, if we were buying any of that, we're going to buy that as well. And one other thing I want to note is, as you'll see, we have our startup. We don't decide to start a business and start making money on day one, right? We have a period that we ramp things up. So in our startup, these are dollars that are occurring before the first donut is sold. So that's why we have this column here before anything starts. And as you can see, we have our kitchen equipment. It's going to cost us $35,000. We have our dining area furniture at $10,000. Other costs of $1,350, our POS system of $975. But before we even open the doors, we are in for $47,325, right? And you can see how that may stop somebody from starting a business. It's a whole lot of money before you even open the doors. Additionally, before we open up, while we're not selling donuts and we don't have the cost of making the donuts, we do have other general and administrative costing. What do you want to do before you open your shop? You have to pay utilities, so you are going to incur expenses there as well. Luckily, with our sales and our cost of goods sold, it was all based on our sales forecasts. With our SG&A, we can budget it. We can actually figure out what we want to do. We want to do heavy advertising up front. It may phase out towards the end. We spend more on our website up front, and then the maintenance may diminish over time. We may have advertising go up, but as we forecast this out, rent's not going to change for the next 12 months because our lease says so. Our utilities, they might change by 1 or 2%. We don't need to be that exact in how we forecast that out. And we push that out to the full 12 periods as well. From there, we actually, as we mentioned before, take our gross margin less our startup costs and our SG&A costs, and we come up with our net cash inflow or outflow. Do we want net cash inflow or outflow? We want inflow, right? So our net inflow is our net income, our net outflow is our net loss, especially for us, we're a cash basis, right? Going back to the example I gave before where there's delayed payments, in an accrual basis, you could have net income showing on your sheets, and with a net, because of terms and the way you're getting paid, be at a negative cash standpoint because there's a 45-day lag on when you get paid. So we're going to do this exercise twice. We're going to start and just say we're putting $0 in the company. And if this were a theoretical company, how long would this company last, or how big of a hole would it dig itself into at $0? Can any company run on $0? Can you get anything done on $0? No. But this is an exercise that I highly recommend to see where you should start in raising your capital. So what we do is we start with our beginning cash balance at 0. And then all we do is we transfer our net cash inflow or outflow from our previous exercise. So if we start at 0, we have a cash outflow of $59,050. We end in the hole $59,050. Do we still want to do a donut shop? It feels kind of gross, you know? As we start with a 0 balance, we transfer our net cash outflow. We're at $59,050 before we even start up in the hole. Our next month, our ending balance for the previous period becomes our beginning cash balance. We have a cash outflow of $5,953,000. Therefore, our net cash balance is a negative $65,000. And we keep on following our cash balance. We do that through the entire period, okay, or through the entire length of time that we're doing this exercise for. However, while our negative cash balance continues for several months, you can see eventually around the 7th month we start to become profitable, right? And this goes back to the previous example. Just because we got profitable here does not mean we broke even. It just means this is what we need to do to become profitable. But as that profit continues, you see we end up breaking even between the 10th and 11th month. Okay? The reason I recommend starting with a 0 balance is you can see at this point, the lowest we get in the hole is $73,000. Okay? So let's do this exact same exercise, but pretend we put a $75,000 investment into the company, and we start out at $75,000. So from there, even with the same outflow coming in, we have a positive cash balance. And this is more realistic. This is truly how your business will run, but you want to find out when you'll run out of cash. And as you start going down the entire path, you can see that the lowest point of cash you get to is $1,866 in your bank. The profitability doesn't change, nor does the break even as well. So same philosophy as if you started with 0 balance, but now you can figure out what you're putting in the bank and what the lowest is. Again, this is all based on assumptions. And the number one rule, they mention this even in the book, is everything costs twice as much as you think it's going to and take twice as long. So if we're thinking it's $75,000, it might be $150,000. If we think it's month 6 that we're profitable, it might be month 12. It's best to plan conservatively.
Thanks for watching. Make sure to subscribe to our YouTube channel at youtube.com/Nexagy Education or visit chasmreward.com to catch up on previous episodes.